This presentation, I want to talk about the downsides, the pitfalls of social impact investing, what you need to know. If you're considering investing in this, you want to utilize this particular strategy. While social impact investing offers several advantages, it also comes with certain disadvantages that investors should do well to consider. And so here are the key challenges, the pitfalls that comes with social impact investing. In this context, we have number one, there's that lower financial returns. Social impact investments may offer lower financial returns compared to traditional investments, especially if the primary focus is on achieving social outcomes, rather than maximizing profits. Right from the word go, you don't expect to really gain much financially. The core and motivating factor there is to be able to impact the community, to impact the society positively, and then the issue of monetary rewards can come in later. So you don't really expect much from it. Is that lower financial returns? Number two is higher risk. There's this issue of operating in a higher risk environment, So many social impact projects are in early stages or involve sectors with higher volatility, such as social enterprises or emerging markets. This can result in higher risk of failure or lower than expected returns. It's inherently risky, particularly if these projects are undertaken in emerging economy in underdeveloped countries. So the idea of you making money can be somewhat slim because of the nature of the country or the sector you are investing in. So it's relatively risky. Number three is difficulty measuring social impact. How do you measure social impact? That difficulty is there, and so measuring the effectiveness of social impact investment can be challenging. Unlike financial returns, social impact outcomes can be subjective, making it hard to assess their true value or compare investments objectively or effectively. So it's difficult to measure because you don't use the traditional accounting metrics to measure social impact, the result of social impact investing. So it's somewhat difficult to measure. Number four is limited investment opportunities. Limited investment opportunities. The market for social impact investments is still developing, and opportunities may be more limited than those available in traditional investment markets. This can make it difficult to build a diversified portfolio because of the fact that the opportunities in these areas are kind of limited. It becomes very difficult for you to be able to build an adequately diversified portfolio due to the fact that these investment opportunities are difficult to come by. Number five is liquidity issues. There's this issue of liquidity. And so social impact investments may be less liquid than traditional investments, meaning it may be harder to sell assets quickly or to exit an environment. It's difficult for you to sell your investments when the need arises. Unlike traditional investing, you just go to the market, the stock market, and then you offload your shares, and that is all. When it comes to this kind of investing, the liquidity is not always there. It may be difficult for you to sell your investments when the need arises. Number six is potential for mission drift. There's that potentials for drifting away from your core mission or core vision. So over time, some companies or funds may shift their focus from social impact goals, towards maximizing profits. a phenomenon known as a mission drift. This can dilute the social impacts the investment was originally intended to achieve. Sometimes, there could be that drift away from the social impacts you initially intend to obtain into like a pure profit motive. So that temptation is always there to drift away from the initial vision, the initial mission, the initial objectives you sought to achieve. Number seven is greenwashing. Some companies may exaggerate their social or environmental impacts to attract impact investors. A practice known as greenwashing. This can mislead investors into supporting businesses that don't live up to their claim. They will tell you, okay, this is what we want to do. These are aims and objectives. We want to obtain or create a social impact in our community or in the environment, and then you key into that particular goal, not knowing that the company concerned is not being truthful. They're not really willing to be guided by what they say they will do. And that particular practice is known as greenwashing, false claim. When it comes to what they want to actually, get involved in. Please like this video and subscribe to this channel. Number 8 is a regulatory and policy, uncertainty. Regulatory and policy uncertainty. Social impact investing can be influenced by changing government policies, regulations, and incentives. Political changes or shifts in government priorities can affect the viability and stability of social impact investments. So this kind of investing could be influenced by government policies, could be influenced by the prevailing regulatory environment, unlike what may be obtainable in other kind of investing, other strategies of investing. Number 9 is a short-term focus of some investors. Some investors may expect quicker returns, but social impact investments often require long-term commitments to generate meaningful social change, which might not align with short-term financial objectives of the investors. If you want to key into this particular investment, you must have a long-term perspective. You don't expect your money to yield result in the short term. You must be willing to be patient until the social impact is obtained, is achieved, and then the profit motive will come in later. Number 10 is complex due diligence. And so conducting thorough due diligence on social impact investments can be more complicated and time consuming than traditional investments. Evaluating both social and both financial and social outcome requires specialized knowledge and expertise for you to be able to analyze, for you to be able to conduct critical due diligence on an investment, to be able to know precisely whether you should invest in it or not. That's comparing the social outcome with the financial objective can be kind of daunting. It requires a certain level of expertise. And so despite these challenges, social impact investing remains a powerful tool for those who want to invest in ways that are kind of aligned with their values, while still pursuing kind of financial objective, financial returns. So investors must weigh these disadvantages against the potential social benefit or impacts they want to obtain, in line with their investment principle. So you need to balance the two. And in the light of their disadvantages, we've just considered in this video.